People say, well, gee, the Fed, at the height of the pandemic panic, going back to 2020, the Fed's balance sheet was up to about $9 trillion. I had to get used to saying trillion instead of billion, but about $9 trillion. And it's come down a little bit since then. But people say, well, wait a second. How can there be a dollar shortage or a liquidity crisis when the Fed printed $9 trillion? Well, the answer is you have to understand how the money system works and where real money creation comes from, and it does not come from the Fed, and here's why.
In this video, Jim Rickards provides a detailed explanation of the U.S. dollar's strength amid economic challenges and sheds light on the complex dynamics of the global financial system. He emphasizes that despite the Federal Reserve's massive balance sheet expansion, true money creation doesn't come from the Fed, but rather from the banks through loans. Rickards highlights the significance of the off-balance sheet derivatives market, amounting to a staggering $1 quadrillion, and how collateral, particularly in the form of Treasury bills, plays a crucial role in supporting this complex financial network. The strength of the U.S. dollar is attributed to the heightened demand for dollars worldwide, driven by the necessity to acquire Treasury bills for collateral purposes. Rickards explains the reverse repo program, revealing how institutions scramble for Treasury bills, creating a significant demand for them. The urgency to obtain these bills, even at lower yields in the secondary market compared to the Fed's offerings, indicates the underlying desperation and signals the beginning of a liquidity crisis.
The Fed did print the money, that's real. But the way they do it, the Fed buys bonds and Treasury notes from the primary dealers, from the big banks. And they call up and offer me a 10-year note. Okay, here's the price, done. Goldman Sachs will send the 10-year note to the Fed, and the Fed pays for it with money that comes out of thin air. So that is money printing. It's as simple as that. But then Goldman Sachs, in my example, takes the money and gives it back to the Fed, because the Fed's a bank. They deposit it at the Fed in the form of what they call excess reserves, and the Fed pays interest on excess reserves, so the Goldman's actually making money off it. The point is the money didn't go anywhere. The Fed did create it out of thin air, that much is true, but the recipient who sold the bonds gives it back to the Fed. It sits on the Fed's balance sheet. So the asset side, you've got all these Treasury notes, but the liability side, you've got all these deposits, and it just sits there and it doesn't do anything. So where does the real money that powers the economy, if there is, if it does at all, where does that come from? It comes from the banks, because the banks can do the same thing. When the bank makes you a loan, what do? You're a business, you set up a checking account. They say, okay, here's $1 million loan. They put the $1 million in your checking account. Where'd that money come from? They just said you got the money, right? And so they have an asset, which is a loan from you with note, and they got a liability, which is your deposit. So banks create money kind of the same way the Fed does, except it's supposed to be in private commerce. And that money actually can go somewhere. If you're a business, you got a payroll, you got to buy stuff or invest stuff, et cetera. But there's not much of that going on. Velocity is very low. The turnover of money is low. The M1, M2, those are different forms of money. I love the fact that the Fed has M0, M1, M2. It shows they don't even know what money is, because they got 3 different flavors. But the point is that hasn't really been going anywhere. Now, but here's the key. $9 trillion on the balance sheet, maybe, 5-6 trillion today. It's a lot of money. But the notional value of derivatives off balance sheet of the banks is $1 quadrillion. And for listeners who might not have heard the word quadrillion before, 1 quadrillion is 1,000 trillion. So your 9 trillion at the Fed doesn't get you very far if you have to support 1,000 trillion dollars worth of derivatives. And how does that work? Well, the answer is mostly the banks doing off-balance sheet swaps and swaptions and other futures and forwards, and we don't have to go down the whole litany of names, with either each other, because they're trading firms, or with hedge funds who want them for speculation or hedging, or sovereign wealth funds or other institutions. There's a whole network of participants. But these are the big boys. These are the trillion-dollar institutions, the BlackRock and the Temasek and the Sovereign Wealth Fund of Norway. These are the big players involved in this market. Okay, so you have $1,000 trillion of derivatives off balance sheet. By the way, you will not see this looking at a bank balance sheet. You got to read the footnotes. You got to know what you're looking at. How is that supported? Well, it's supported with collateral. Not 100%, not even close, but maybe 1%, 2%. You got to put up some margin money to be in the game, but then you can have a lot more off balance sheet. Okay, so what's the best form of collateral? Well, it depends. Whether you're in a liquidity crisis or not, whether people are feeling confident or are worried, whether they think things are going to go great or start to collapse. So as things get more difficult, and that's the phase we're in right now, the quality of the collateral has to go up. So the banks are now saying to each other, I don't want your mortgages. I don't want your stupid corporate bonds. I don't even want 10-year treasury notes. Get me bills, treasury bills. These are short-term, very liquid, 1-year maturity or less. A lot of them are 4-week bills, 8-week bills, 6-month bills. These are very short-term, very liquid. They are the best collateral there is. And the banks are saying to each other, that's what I want. Okay, so now you're Barclays Bank or Deutsche Bank or Unicredit, Credit Suisse or bank, some major Japanese bank, etc. Where are you going to get the bills? Well, you got to buy them from a dealer, or you can buy them at auction. The Treasury has auctions, or you can get them from the Fed. But to buy a dollar-denominated Treasury bill, you need dollars. So that's why the dollar is so strong. Everyone's like, hey, Jim, we got these huge budget deficits and $1 trillion of expenses and bailouts and handouts and, 131% debt to GDP ratio, $31 trillion in debt, et cetera. How can the dollar be so strong? Well, the answer is, it has nothing to do with everything I just said. The dollar is strong because everybody in the world needs dollars to buy treasury bills, to prop up the balance sheets of the 1 quadrillion of derivatives that nobody can see. And this is real inside baseball in terms of how the international monetary system actually works. So the strength of the dollar, which by the way is a headwind for gold, the euro's down, sterling's down, the Swiss francs are down. Gold hasn't actually gone down a lot. It hasn't gone up a lot, but it's holding its own. But a strong dollar means anything denominated in dollars is going to go down, because if the dollar gets stronger, the dollar price of the commodity gets lower, or at least doesn't go up a lot. Okay, so first of all, you got a mad scramble for dollars. Why? To buy treasury bills. Why? Because they're the only collateral to prop up everything I just described. Now, but there's evidence of this, and again, you have to know where to look. So right now, the Fed has what they call the reverse repo program. What is that? Well, any bank, any major institution that wants treasury bills can call the Fed and say, give me some treasury bills. And you give the Fed cash. It can be overnight or a couple of days, whatever. The Fed pays you interest, so you're making a little money. But they send you the treasury bills. Well, why isn't that the solution? Why doesn't that work? Well, the answer is you can do that, and you can get those treasury bills, but you cannot rehypothecate them. You cannot pledge them to anybody else. You have to keep them. And the Fed might want to unwind that at any time. Well, that's not good enough, because if I'm supporting some other transaction with somebody else and they're supporting another transaction through a chain of, could be 25 banks, all in the same, back to back, I want treasury bills that I can pledge to Credit Suisse, so they can pledge to Barclays, so they can pledge to JP Morgan, et cetera. So I got to get treasury bills either at auction from the Treasury, and they're not issuing that many because actually the budget deficit is coming down a little bit, or buy them in the secondary market. So if I'm a bank, I can call up the Fed and get treasury bills, in 15 minutes, and there's a certain price. They're going to pay me interest. I'm going to get a discount and give it back. If I buy it in the treasury market, there's also a price. I got to, they always trade, they mature at par. So you buy them at a discount, and the difference is how much interest you make. Okay. The yield to maturity on the treasury bill that you buy in the secondary market is lower than what the Fed will give you for free just by picking up the phone. So why would you ever buy a treasury bill in the secondary market with a lower yield than what the Fed will hand you? Well, the answer is because you can rehypothecate it. You're desperate. You're willing to take less yield to get the one that you can pledge instead of getting a higher yield for the one you can't pledge. So it's all about the rehypothecation. But the point being, the fact that yields on secondary market purchases are lower than what the Fed will give you for free tells you how desperate people are to get those bills. That's the beginning of a liquidity crisis. I spoke to someone recently. I said, well, Jim, I hear you. When's all this coming to a head? And I said, maybe this winter or this spring, sooner than you think.